Okay, so this guy here is what she's talking about. Market price NAV. NAV means net asset value, and that's the price of the ETF. Okay, so when you see, let's say, I don't know what the price is right now. Okay, so the market price is, I'm not sure why they have a net asset value and a market price, but here it's the same. So it's not an issue. MER is 24 basis points for a all equity. Okay, so let's see actually what all equity actually means. And I'm glad you kind of dropped this, Laura, because a lot of our students kind of get stuck in the picking the ETFs section, and it really is not, it shouldn't be the case. So we're looking to kind of like not revamp, but add some more resources to that section. But this is I think going to be helpful to a lot of students who are here today. Okay, so what does all equity mean for them? A lot of this stuff is very fancy stuff that I literally just, first things first, we want to find out what does all equity mean for them. And that information is not here. So let's go to the fact sheet. So we're going to look at both of these. Let's look at the fact sheet. Every fund has a fact sheet, something with just like the high level information. Let me make this a little bit bigger. Okay, so it says the Vanguard all equity ETF portfolio seeks, so it's in the objectives here, seeks to provide long-term capital growth by investing primarily in equity securities. Okay, so it's equity, so it's stocks. Now let's see what kind of stocks, what size the companies are, what geographically, how, where are they located. So I'm just trying to find that, especially the geographic concentration of this fund is probably the number one thing that I would look for here and that I am looking for. Okay, it says just, while we're looking for that, it says eligibility. So this is for Canadian, this product is meant for Canadian investors. It says, you can put in your RSP, your RIF, RESP, TFSA, I think this is DPSP, I think it's the Disability Savings Plan, or you can just leave it taxable. So the management fee is, or the MER is 24 basis points, so 0.24%, which is a little bit on the high side for a standard stock ETF. This is kind of like my first line of thinking, but let's explore more. I'm not going to jump to conclusions because I don't actually know what's in this ETF. So, so here is the answer to my question: allocation to the underlying fund, Vanguard. Okay, so these are the funds that are in this all equity ETF. So this is a fund of funds, which means that the ETF is made up of other smaller ETFs. Okay, and then it packages all of them for you in a neat bundle, so you don't have to go picking different ETFs. So this is what the school principal meant when he said it's like nicely bundled, and if you don't know anything about investing, this is a good go-to. So he wasn't wrong there. And so Vanguard US Total Market ETF. So the first biggest holding is a US ETF, US stock ETF. So 43% is in this US stock ETF. The second biggest is in a Canada all cap. Okay, so these are all words that I like hearing. Total market means looks at the whole market. Okay, it's not picking and choosing different sectors. It just ticks the whole thing, which is, what exactly our methodology here. Canada all cap, again, same thing, all cap, all capitalizations. Capitalizations means size of the company. So small, medium, large cap, it has everything. Vanguard, so the third one is Vanguard FTSE Developed All Cap X North America. And so what this is basically is developed, so developed world. So it's like Europe, Australia, Singapore, what other developed countries there are outside of US and Canada. These are going to be included in this FTSE Developed All Cap. I suspect it's a lot in, yeah, Europe, and then maybe like Korea, like South Korea, Australia, New Zealand, Singapore. That's kind of the countries that come to mind. And essentially, when you see this ex North America, what it's meant for, they've designed this ETF with North American investors in mind. So investors who are in Canada or the US and already have a North American holding. So holdings like see the US we already have and the Canada we already have. So let's say you bought a kind of all world ETF. You would be double dipping on the US and Canada, okay? You would be like getting more exposure than you want, and also it becomes very messy and difficult to kind of figure out like how much percentage you actually have in Canada if like both of these have, you know, percentages and, you know, asset allocations in Canada or the US. It becomes like, you know, we don't need that hassle in our life, okay? We like keeping things simple at investing for boss ladies. So the third one is kind of meant as like a wrapper, so that you have your US and Canada right here, and then you have the other developed countries, so that all you have exposure to all developed countries in the world, really. And then so if we've already gotten our developed, the only thing that's remaining is the emerging markets. So emerging markets is anything, you know, there's a lot of emerging markets countries. The bigger ones, the more developed ones will be represented here. So it's going to be like India, China, I think is still considered developing. Brazil, Russia, those are like the big ones. They're called the BRIC countries, BRIC. And then after that, it's, you know, there's all different countries in Asia, the Philippines, Indonesia. Those are all going to be in emerging markets. Eastern Europe, there's emerging countries. South America, there are emerging countries. Central America, Africa, you'll probably get access in this to Egypt and South Africa. The other countries are usually considered too developing, or they call them frontier countries sometimes, because they're like, stock market isn't even developed enough to kind of package and sell to outside investors. So, you know, you when it comes to emerging markets, they don't go and invest in every single country out there. They invest in like the bigger countries that are more developed, where the markets are more efficient and reliable. Okay, so there you have it. You have like access to the whole world. So actually, the principle was not that wrong. And especially like I never recommend kind of a blanket solution for someone without knowing what their, you know, what their risk tolerance is or their personal situation is. And we do that through the Vanguard questionnaire, the risk tolerance questionnaire. But, you know, and also there's no bonds in this. Okay. So that's the other thing with this. You would still need a bond allocation. So those are like kind of, it's not a bad start. And especially someone like your son who is young, he, you know, doesn't need a huge bond allocation. It's actually a reasonable thing that this principal recommended, and I hope your son gets accepted if he wants to go to this school, because the principal seems pretty smart.
Thank you.
Yeah, and if you are like really lazy, you can actually find ETFs that also have bonds in it. So then you kind of don't need to do anything. However, okay, the downside to that is that you can't customize it. Okay, so what you see is what you get. You have to be okay with this 43% allocation to the US market, this 30% allocation to Canada, 19% elsewhere, and 7% in emerging markets. Like this is, you know, what it is what it is. Okay, there's no customization that can be done. You know, if you, let's say, add bonds, you can You can, it's not a bad, I'm not saying this is a bad allocation. I don't see anything wrong with it. It's just that you personally have to be okay with it. And then you would need to figure out how much, what percentage to put in bonds. And that's probably your biggest decision, to be honest. That's your first level decision. What percentage to put in bonds versus equities. And then this could be the equity holding if you're not, if you think this is reasonable. The only thing, oh yeah, the other thing is that it's not the cheapest option. If you created this fund, if you did the asset allocation yourself and found out, just assembled this thing by yourself, this ETF, it would probably be, I suspect, cheaper. Because the US total market, US stock ETF should be very, very cheap, for example, and the Canada as well. The other guys will maybe be a little bit more expensive. But like anything, if you have more, if the work is done for you, it's going to cost you a little bit more. And if it means that you're actually going to invest rather than being like, oh, I'll do it one day and you don't invest, paying a little bit more, but having it done and actually doing it is a way better, option than not doing it. So, we have to be, it's not just what's best on paper. It's, know yourself and accept accept the way you are and just, work with it. So yeah, everyone is different. If, this works for you, I'm not going to tell you that's not to do it. Okay, so the numbers, this is more information. Number of stocks is 13,000. What else is here? Okay, so sector weightings, tech is almost 20%, financial is almost 19%. This is pretty common today that the tech stocks, like Amazon, Apple, Netflix, Google, all of these guys have become very, very big and take up a large part of the US stock market, certainly. Financials also, banks take up a big part of, especially the developed countries, there are stock markets. And then it goes on to the other consumer discretionary. Consumer discretionary, what it is, stuff that individuals spend money on. Like when we go to the store, stuff we would buy that's not necessarily food. Or maybe it includes food as well. Anyways, it's kind of retail oriented. And then it goes on to all the sectors. So there's nothing wrong with this per se. Just you need to make sure that it fits into your allocation. You can still go through the program and be like, oh, actually, this is super easy. The other good thing about something like this is that they rebalance it for you. So you have less work to do when you rebalance. So I don't know what their bands are, but I suspect they keep it somewhere around 40% goes into the US, around 30% goes into Canada. And these numbers will also always be fluctuating, okay, based on the stock market fluctuations. But if it goes beyond a certain limit, they will rebalance and keep it in check for you, okay? So then all you need to do is keep your bond and equity allocation rebalanced, because you still need to add bonds to this guy. ETF facts. Let's see if there's anything here that we find interesting or relevant. This is another reason I like Vanguard. It's pretty the information is fairly easy to find. You don't need to go here and there. Oh, this is interesting. It says, before you invest, consider how the ETF would work with your other investments and your tolerance for risk. Okay, very, very important. And that's exactly, this is investing 101. So it's not just how in investing in this on its own, but if you have, let's say, a bond allocation that goes with it, it's going to reduce the risk of the whole thing altogether. So instead of, let's say, the equity ETF is the risk is here. You add some bonds. Bonds are less risky, but the bonds, because they diversify equities, the risk of the entire portfolio will drop. So the sum of the parts is less than, you don't add it up. It has to do with correlations to get a bit mathematical. So the more different the holdings are, the more diversification you're going to get, and the more it's going to reduce the risk of your portfolio. So even though, let's say, in emerging markets, holding is on its own more risky, if you add it to US or Canada, US Canadian equities, it'll help bring the risk of that portfolio down, because emerging markets behave differently than US and Canada. Whereas US and Canada are each other's biggest trading partners. They are different countries. Economies are very different. However, they are each other's biggest trading partners, which means that when one suffers, the other one does as well. If the US suffers, Canadian economy suffers as well. So the diversification benefits are less compared to if you add an emerging market to the mix. And then also if you add bonds, that's a completely different animal, behaves completely differently, and it's actually yin and yang when it comes to equities, and equities and bonds are yin and yang. Okay, so let's see if there's anything else here that we find interesting. They say that the volatility of this ETF is medium. I don't find this super helpful, because it's like medium compared to what? But yeah, according to them, it's medium compared to maybe some of their other ETFs. So it says one way to gauge risk is to look at how much an ETF's return changes over time. This is called volatility. In general, ETFs with higher volatility will have returns that change more over time. They typically have greater chance of losing money and may have a greater chance of higher returns. Okay, and vice versa. Lower volatility means lower chances of higher returns, lower chances of lower, market thing falling in price as much. But here's the interesting thing, and this is what I've seen through coaching women to invest, is that we don't necessarily see risk in this way. The way that the market prices risk and the way that the market defines risk is a very male-centric view, because men cannot sit and do nothing. When the market is up or down, they have a lot more chance of like doing something and like making mistakes. Whereas, when the market is up, I tell you just stick with the game plan. The market is down, I tell you to stick with the game plan. Women are a lot better with sticking with the game plan and not getting emotional, or just sitting tight and not doing anything. And in my view, volatility is less of an issue for women compared to the potential of dying poor. So those are two very different things. If, yes, you can take very little risks today and have a portfolio that doesn't do this too much. But that if you might have a portfolio that has very little volatility, but that increases your chance of running out of money. That decreases your chances of having a comfortable retirement. That's something that's not really talked about and that you should hold into consideration. Taking less risk now means that, I'm not talking about, people who are close to retirement, but if you have like 15, 20, 25 years left to retirement, the more risk you take in your calculated risk you take in your portfolio now, it's going to increase your chances of hitting your retirement goals. Okay. And this is something that like women are better long-term investors, because we understand intrinsically that there will be some ups and some downs. And yeah, although it might be a little bit uncomfortable when the market is down, it's part of the game, and we're looking for that long game. Okay. We're looking to save for retirement. We're looking to make sure that we don't run out of money. So when you read some of these things, you might want to keep that in mind. Does anyone have any questions on that? What I said was actually pretty technical, and I haven't heard anyone talk about it, and that's why I'm talking about it. see here, they're talking about previous year's returns. Okay, this chart shows how the units of the ETF perform in the past 1 year. I think it's a new ETF. Otherwise, I don't see why they would just give you 1 year return. Oh yeah, here. ETF start date started is January 2019, so 2019, 2020, there's almost 3 years of returns. I don't know why they're just showing 1 year. Maybe this is not up to date. Oh yeah, it's December 2021. Okay, they haven't updated this. Oh, this is interesting. Under securities laws in some provinces and territories, you have the right to cancel your purchase within 48 hours after you receive confirmation of the purchase. Shouldn't be the case, but know that, like, if you're like, oh my God, I made a huge mistake, this is possible. And also, your broker can also reverse certain trades that haven't settled. There's also that.